In last week's commentary, we mentioned to expect a tumultuous week, and that's just what we got. The most important story we were looking at last week was the VIX backwardation, and you can see here on the screen that this is Sunday evening, and the markets have opened, and this blue line, we're at VIXCentral.com, and the blue line is currently what the VIX term structure looks like, and the gray line is where we closed on Friday. So as you can see, the VIX is still in backwardation, and the October contract is about to expire. Looks like in 2 days. So I think Tuesday. And the November contract will become the front month. And so a lot of people are already trading the November contract, and they're not really trading the October one anymore. So this is really the more meaningful contract at this point, the November one. And it's still above most of the curve, but not the whole curve. So what happens in the next few days, I think, will determine whether or not this starts to revert back to a normal curve or not. So next thing that we want to cover is the market breadth. We're tracking market breadth for the past week with IWM and SPY ratio. And so this is the entire duration. Let's zoom in a little bit. So what we wanted to show right here is you could see that as the market rallied last week, the breadth turned first, and then the market started to rally, like right here. And the breadth kind of followed it. And it was up from way oversold levels here. The small caps had just been completely pummeled. And when the market bounced, the small caps led the way. So let's look at just the small caps. And you could see that they kind of were up ahead of the SPY. So here's SPY.
Well, that makes sense because small caps are less liquid and tend to have bigger downward as well as upward moves, right? They're always going to be a little more
higher
volatile.
beta, higher
beta.
volatility.
That's right. Higher beta.
So right here, you could barely see is the candle low from Wednesday. Big reversal bar on the SPY. IWM. It just barely made another low on Wednesday. It just barely crossed below Monday's low. If I'm reading that right. In last week's commentary, we also looked at the recent range expansion in SPY. What was really interesting, let me actually back this up so that we can compare it to, I'm going to put it on last Sunday so we can look at what we were looking at back then. And we were comparing this price action right here, these sort of very tall bars coming in near the market highs, is that this looked really similar to the way the market looked right before the flash crash of 2010. So we're just going to take another look at this now that we have more information of last week kind of playing out. Let's just kind of extend the comparison. So let's cut this off on the 6th. I'm actually going to use this date down here and then roll this one back. Okay, so this very choppy behavior here all the way up to May 5th. And now let's play it forward a couple of days. We'll play it forward 1 week, actually. And as you can see, the market's in a big bounce here after the flash crash. And we're kind of in a similar spot now. So when I clear this date off and then zoom this to the beginning of this year. So there we go. It's looking pretty similar. The market is up right here on a bounce. And so we'll go into a little bit more about that in our kind of conclusion for the week. One other thing we want to look at here before we move to that is pricing gasoline in terms of the S&P 500. And for 2014, you can see that this has been kind of a leading indicator on the downside. We noticed this a long time ago. We've been tracking it kind of all along. You could see gasoline prices falling at the pump, and so it was kind of a very noticeable divergence here in August. That the stock market was actually up, I think, at that time or near the highs, and gasoline was down a lot, and that has not been a normal thing for quite some time. So when I zoom out, you can see here's the 2008 crash, and it's just been fairly stable ever since until just recently it broke below this kind of support level here.
Now, isn't that counterintuitive? Lower gas prices leading to a lower stock market? Traditionally, it hasn't always been lower gas prices, lower costs of doing business, more economic activity.
Right. Well, that's sort of like I guess the other way of looking at it is the lower stock prices go, the better the deal that they are. So does that mean that they don't crash? No, they still do, but it can be like a self-correcting thing, and so maybe as this plays out, we can look for that to happen. There's also you were mentioning this earlier. There's like a political aspect to this, and
rumor has it Saudi Arabia is suppressing the price of oil right now, right?
Yeah, and so that's imposing economic turmoil on other countries, maybe Russia being one of them, maybe even the United States. It's hard to say what all the consequences of that are going to be.
It depends on each country's cost, each company's cost that has a hand in the whole oil market, and what they can do to bring in other revenue streams, right? I mean, it is complex, but I find it very interesting that lower gas prices are leading stock market lower in this case. But I have a hunch. My theory is that it's political.
Yeah, that's a good theory. Let me take the chart out 1 second and just look at 2014, and I'm going to clear off this ratio, and I'm just going to put SPY up there by itself. And I mean, it's kind of like I said in August and September, the market was up at the highs. And when we look at gasoline here by itself, there's this big divergence here. So I think we saw, $2.73 a gallon, something like that today in St. Louis. Really, really low prices. We haven't seen gas prices that low in a long time.
Can you throw this up on a component chart so we can see them?
Sure, yeah, that's a good idea.
Yeah.
So it's a really exaggerated move when you look at it like that. This huge spread coming in. So and this big rebound here. I mean, it's maybe people playing on this spread to close.
Or could the acceleratingly falling gas prices here be propping up the S&P 500, keeping it from completely rolling over?
That's certainly an angle. So let's actually look at a spread chart here. I'm going to render the spread chart. So if you went long gasoline and short the S&P to play this gap to close, you haven't really made much yet. So and this is different from the ratio chart, by the way. So not to be confused, the math is slightly different. So anyway, One of the things we wanted to get to is they're out on the internet this weekend. Zero Hedge published this, and there's been a lot of coverage over this. It's the parallels between S&P 500 in 2014, this kind of down move in the markets, and comparing it to 1987. This is October 19th, 2014. So exactly 27 years later. Black Monday was October 19th in 1987. So this kind of brings us to our big takeaway for the week is we're regarding this rally that started from the reversal bottom on Wednesday as the first of possibly many volatile bear market rallies. So that's kind of how we're approaching this right now, based on all the evidence that we're looking at today. And that could change on a daily basis, but those are some of the big factors that we're looking at this week. Thanks for watching, guys. We're portfolioworkstation.com, at portfoliows on Twitter. If you like the video, please thumbs up and subscribe to the channel. Thanks.